Hello and welcome to the portfolio management material. I'm sure you are excited to be going through this. So you've got through a lot of material so far. We're kind of past the middle of the curriculum if you're going straight through. So I guess that's something to be happy about. But I think you're going to find the material here to be fairly straightforward, right? So we're going to have an introduction here. We're going to see some other sort of basics, the ways to think about portfolio management. Also an introduction to the mathematics of portfolio management, which are kind of a mainstay of the level 1 portfolio management material, and as well as some other things. But nonetheless, there are going to be some formulas, some quant stuff as we go through the entire study session, but it's not going to be too bad. And it's going to be relatively limited in the sense that a lot of it you will have already seen from other places in the curriculum. So you kind of got to jump on this material, even though we're just getting started. So let's start out with this overview reading. Like I say, this is, again, pretty straightforward, but it's worth spending a little bit of time thinking about the problem that we are trying to solve when we think about the portfolio management problem. So the portfolio perspective, okay, we're going to evaluate investments based on their contribution to the risk and return of an investor's overall portfolio. And what that's saying is something really important. So the portfolio perspective means that we're not looking at the total risk and return for an asset when we are considering whether or not to buy it for one of our clients. Rather, we're looking at the contribution to the risk and return of the overall portfolio. So in terms of what we'll later see as our risk calculations, it's the difference between total variability and systematic risk. And the terms we're going to use are standard deviation and beta. So we need to think in terms of overall contribution to the risk and return of the portfolio, not the individual asset itself. And what that does is creates a world where you can take a very risky, limited partnership type investment that has, really high standard deviation, but also low correlation with an existing portfolio. So you take this really risky investment and put it into a little old lady's pension portfolio and actually increase return. At the same time, you're reducing risk. Right? And if you're not familiar with that story, well, we're going to see it as we go through. So the overall portfolio, the portfolio perspective is key to understanding essentially everything we're going to do in this study session and most of the CFA exam at its core. So adding a risky asset can actually reduce portfolio risk. We have here the diversification ratio, which is the standard deviation of an equally weighted portfolio's returns. So take the portfolio return, say 100 securities, weight them equally, find the standard deviation, and we're going to take that and divide it by the average standard deviations of returns on the portfolio assets. So if this comes out to be, 0.6, right, then what that's telling me is that because of the diversification factors in the portfolio, we have only 60% as much risk in the portfolio as we would have if we were holding a representative asset. So we're able to get rid of 40% of the risk, the standard deviation, by taking advantage of diversification, which of course comes through looking at a portfolio perspective. So endowments, we'll talk a little bit about the different types of investors here. So endowments, these are essentially eternal organizations. They're to provide ongoing financial support for some particular cause. When they're associated with charitable causes, we frequently call them foundations. So this could be something that is supporting some sort of NGO, non-governmental organization, in their efforts to deal with childhood disease in some needy place, right? Botswana, I don't know, Zambia. So anyway, so an ongoing financial support. Well, if we are managing this endowment fund for this particular NGO, well, what are going to be the factors that affect this particular investor? Well, typically endowments are going to have really long time horizons. Why? Because they're supposed to provide support forever, right? So these are essentially eternal time horizons that we're working with, and they're going to be ongoing. They're never going to be anything but ongoing. At least that's the design behind these organizations. So the risk tolerance, these are typically viewed as a class anyway. There could be differences between endowments, but as a class, these are probably viewed as the the type of investor that can have that has the highest risk tolerance. And the reason is they've got so long, right? So they've got an eternity on which to make up any ups and downs or downs in the market, and also some other factors that we won't go into here. Their income needs are relatively low. It's all they're covering current spending, okay? And then their liquidity needs are also low because they have well-identified cash outflows. So we can plan for it. It's well-defined, and that means that we don't have to have big reserve buffers, essentially. Insurance companies, two kinds. We can look at P&C firms, property and casualty versus life insurance companies. They are similar on a number of dimensions. So they both have relatively high liquidity needs, both because of regulatory structure and because of this need to meet unforeseen claims from their insureds. The income needs are relatively low. Risk tolerance is low because of, maybe because of economics, but certainly because of regulatory constraints. Their time constraints or the time horizons are different. So typically a much shorter time horizon for a property and casualty company, as opposed to a life insurance company who is insuring people who, at least according to the actuarial tables, aren't going to die for 37 years, 3 months, and 4 days. So, or something like that. So a very long life ahead of these, so they're going to have a longer time horizon and consequently probably also somewhat higher risk tolerance than would be a property and casualty company. Banks, of course, what they do is they rent money and then they sublet it at a higher rate. So the loans that they make to you and me, those are assets. They're liabilities to us, but they're assets to the bank. The deposits are assets to us. They're liabilities to the bank. So their loans are assets. Their excess reserves are invested primarily in fixed income and money market type securities. If they've got money that is not being loaned directly to a consumer or to a borrower in the bank market. Okay, so then what is it that they're looking at with the rest of their portfolio? We'd call those excess reserves. Okay, well, the time horizon is going to be short because deposits are very short term. The risk tolerance is going to be low, right? So they can't withstand big losses, again, because of regulatory constraints, but in this case also because of the economic underpinnings of what they do. Income needs, well, they've got to earn enough income to pay interest on their deposits and, of course, cover their operating expenses and, if you're a banker, hopefully some profit. So they do have income needs that are significant, and their liquidity needs are fairly high because a lot of times they have essentially zero maturity deposits, right? They've got at least some portion of their core deposits that are in demand deposit accounts, and there could be a run on the bank or something along those lines. So liquidity needs at banks tend to be relatively high. Other types of investors, mutual funds, and we're going to separate out mutual funds in a little more detail in a moment. Okay, but typically they have liquidity needs that are high because they have to meet redemption requirements from their shareholders. Their time horizon, risk tolerance, income needs, all these other things are going to depend on the type of fund. Okay, big difference between a emerging market equity fund and a money market mutual fund. So the type of fund is going to have a big influence on that. And also fund objectives, what is it that they say they're doing? So all those are going to be very different, and we're going to talk a little bit about those different kinds. A sovereign wealth fund. So a sovereign wealth fund has investment goals that are probably as diverse as the sovereign wealth funds themselves. They're investing essentially for future generations, and they manage foreign exchange reserves out of this as well. Generally, they manage government assets. So I was reading the other night about Abu Dhabi has a sovereign wealth fund of $682 billion is what I was reading the estimate was. So someone is managing the $682 billion fund. Or some people are. Anyway, so that's got to be fun, and they're going to be thinking very long term, looking for the benefit of these future generations. So probably a pretty good gig if you can get it. Pensions, right? A couple of types here. Defined contribution plans. If you happen to live in the U.S., this would be something like your 401k. Right? So defined contribution means that you put in 5% and maybe your company puts in, I'll say 4%, just to have a different number. And so the total investment's 9% of your income, something along those lines. The company doesn't have to match, or doesn't have to match exactly, or can match more than what you put in. But anyway, they're going to have some predefined contribution. But the point here is that the company defines their participation in terms of the contribution. So they contribute a specific period, but they make no guarantees about future benefits. So if you're making $10,000 a month and you save 5% and the company matches that with 4, then you're putting in $900 a month. And whatever that grows to when you retire, well, it's the employee that's going to bear the investment risk, not the firm itself. The firm meets their obligations when they make their contribution. It's a defined contribution plan. On the other hand, we also have defined benefit plans. And this is where the employer promises specific payments after you retire until you die. Usually there's some formula associated with this. It's based on, years of service, your compensation at or near retirement, those types of things. Number of years of service times some percent per year. Maybe it's 2% a year for every year you worked. So 2%, you worked there 40 years, they pay you 80% of your final or some average over the last few years. Of your final salary, and they do that until you die. And in this case, the employer bears all of the investment risk. So typically they would have an asset, okay? So some asset involved in to meet these obligations, and then they would have a liability. That's the promises they've made to their employees. Well, if the asset turns out to underperform, or in the case of many of them, where it's underfunded to begin with, but if it underperforms, it is the employer, or more specifically, the stockholders of the company that made the promises, that is going to bear the investment risk. So the employer here defines what they have to do in terms of the benefit, not in terms of the contribution. And of course, these are going the way of the dodo. And so there's fewer and fewer public sector employees who are eligible for defined benefit pension plans. And typically these are managed as separate legal entities. So there's going to be some plan out there that they're going to contribute to that has some custodian that is managing the assets. Okay, the portfolio management process. So if you're going to manage a portfolio, what is it that you're going to be doing? Well, of course, but if you're going to do this to begin, if you're going to manage a portfolio, you got to have some place to start, and as good a place as any is probably planning what you're going to do, right? So you need to understand the client needs and constraints. We're going to refer to this as objectives and constraints later on. Objectives come in 2 dimensions, risk and return. Constraints, there's 5 of them that have to be considered. You'll see that elsewhere. Then you're going to have a written investment policy statement, right? So the IPS, and this is a big deal, and it's a huge deal at level 3, but the idea is that all investment management, okay, unless you're investing your own funds, should take place under the auspices of a written investment policy statement. So you've got an investment policy statement that's going to define, one, who is the beneficiary or whose money is it? Okay, it's going to have a description of what their needs are, their objectives, constraints, that sort of thing, as well as a bunch of other stuff that we'll get to look at later in terms of, how are we going to update, what is going to be the manner in which these funds are invested, that type of stuff. So the investment policy statement is going to be the written document that governs all of this. We want to develop an investment strategy, okay, that is consistent with the IPS. So the IPS says this. Part of the IPS will be a statement about what it is in terms of strategic asset allocation, those types of things, and then also probably specify some sort of benchmark. We're managing this money relative to the S&P 500. Right, for instance. So we want some sort of bogey portfolio so we can judge whether or not our money manager is doing a good job. After we plan, then of course we execute. So we're going to look at the risk and return characteristics of the different asset classes. That is, we need to know expected returns. We need to know risk. We're also going to need to know the covariance between the asset classes or securities. We want to analyze market conditions so that we know which asset classes are attractive. We want to identify potentially active securities within an asset class. So this means that if you look at these 2 things together, we're talking about the asset allocation decision and the security selection decision. So and we could opt out of that altogether if we went to passive investing. But if we're going to be an active investor, maybe we want to overweight equities and underweight I guess just fixed incomes is the simplest example in some periods, and have some ability for the manager to change that. Within equities, we could also say, well, let's overweight Microsoft and underweight Apple or something along those lines. Portfolio construction, of course, we need a strategic asset allocation. We're going to probably have tactical deviations from that so that we can allow for some input from the manager. That'll also include likely some individual security weightings and some risk management things, something along risk budgeting, so we can put more money into equities as long as we don't exceed total portfolio variability of X or something along those lines. And finally, once we've executed, well, we need to operationalize and then have a feedback loop so that we can see, one, how we're doing, and two, inform what we're going to do in the next period. So monitor and update investor needs. This actually shows up in the ethics material. At least annually, you've got to have an effective update where you ask probing questions of the investor. How have things changed? Do we need to be changing asset allocation based on those changes, that type of thing? We want to monitor and update market conditions, rebalance the portfolio as needed, which is a big one, and then also measure and report performance. So we got to see how we did, report that to the investor, and then of course, if we did well, they'll be happy, and if they didn't do well, then it's not going to be as good a meeting.